Well, hello, I'm Ed Parcaut, your host of Real Estate Jerky, and today I have Brad Veach. Did I get that right? I
Yeah,
always wanted to.
Brad.
All right, he's an A&E with Fund Loans, and basically I had him on the show a while back. We were talking about bank statement loans, which I got a lot of response from, and I appreciate the help on that because I've done a few loans with the bank statement loans going forward. But I've had an individual who came to me who was a property flipper, and he used a lot of private money to get his properties, and now those 10% and 12% rates are killing him, and he wants to refinance them, but he can't show enough income with everything he has going on. And he said, is there any program out there? And then I came across this, what we call it, let me just put this on the screen, a DSCR loan, which means basically it is a debt service loan, right? Basically, is that right?
Correct. It stands for debt service coverage ratio loan.
Right. And basically it allows investors the opportunities of other properties without using what they make. Because a lot of investors can't show with the properties they owe that how much they make, or they're at a deficit. And most conventional Fannie Mae, those programs won't allow them to do this. And so I kind of wanted just to come on the show briefly and talk about it a little bit. What have you found out yourself about these programs? Why did you guys start these programs at your company?
That's a great question. The debt service coverage ratio loan for years was held in the private money sector. It was a loan that was kind of a way in which somebody could own a property and not have to use their own income to support the purchase of that property. And it's made its way into the consumer market, albeit it's what's called a business purpose loan. So unlike I know this gets a little technical, but unlike a TRID-based loan where you have to be able to prove an ability to repay, on a business purpose loan, you can avoid that, where it's a business to business loan. Therefore, the borrowers can use other than their own income to qualify. And so simply put, in a long-winded answer, a debt service coverage loan uses the amount of money that is generated from the mortgage payment or the monthly lease, and you divide that into the principal, interest, tax, and insurance amount. And what that gives you is a coefficient, whether it's negative, neutral, or positive. That's what you use to qualify for the loan.
And that sounds like a lot of numbers that most people don't want to talk about. And basically what we're looking at, and we'll do a couple different scenarios on a purchase or a refinance, but basically what we look at debt. So debt service is big in like the commercial area, right? When they go to get a commercial loan for apartment complexes or other types of investment, they look at what's the debt service, and that's basically how you, whether or not, besides your FICO score and other stuff, whether or not you can that property is worth what you're going to pay for it, and if you can afford it. Correct. And so now what they have done is you guys have brought in these programs over into the regular market for investment purposes, which is really a business loan, but for people to buy properties as investments and rent them and use debt service instead of actually qualifying with your income.
That is correct. Well said.
Okay. Well, I'm trying sometimes, I get it sometimes. All right. So let's run a scenario real quick. So I have somebody who wants to do a purchase. I'm going to pull up my screen I created over here, and then we'll go from there. All right. So let me get this started. Anything you want to add while I'm trying to bring this up?
Well, I just one of the areas that are of interest when it comes to the debt service coverage loan, because it's business purpose, it can close much quicker than perhaps a consumer-based loan where the standard turn time might be 30 days. These can close in as little as 10 days. The key essential requirements are have the property appraised, and usually once the appraisal is done, the conditional loan has been approved, and it's at that point just wrapping the loan up. So these are, especially in a market, a strong real estate market like we've got right now, where time is of essence, this can give somebody a leg up where they can close much quicker than a traditional loan.
And a lot of people will say, well, in this market, it's so crazy. There's no way you can, buy this type of property. Well, I'm starting to hear, and I was on it with talking to somebody from Texas just recently, a few minutes ago before we started the show. And they're telling me they're starting to see additional inventory start coming on the market. So it's starting to slow down, not slow down, but be not so crazy because they can't afford the appreciation and neither can we in California keep appreciating at the 15% or the 12.
Right.
Eventually it'll get to a point where nobody can afford those properties, and they'll go from here. So let's look at a scenario, John. We just
Right.
made that up, right? He wants to buy an investment duplex, right? And I'm just going to read it and then I'll let you jump in. So he plans on buying this property. He's going to keep it for 5 or more years. Most people who are buying investment property, it is a long-term thing. It's not a short-term flip. They're going to do that. This is a duplex. That means they have 2 units, right? Just so in case people didn't understand what a duplex means, that means there's one on each side. They're attached in the middle usually. They can rent each side for $1,800 a month. So that means they have a $3,600 rent payment, right?
Correct.
Total for the month. And so basically, how did you, this was your slides that I cut up, that it said the new mortgage payment is going to be $2,850. Was that based off of, the 5?
Yeah, I'm just using that as basically as a number. We could tie that to an actual loan amount and whatnot, but that's just basically a number where I'm trying to illustrate the simplicity in which you can purchase this home using the debt service coverage, and in this case, end up with a surplus of $750 each month. So, the actual mortgage amount is going to be tied to whatever the loan amount is and the interest rate at that loan amount.
Right. And so we're just using an example that if you had this, here's the example, $3,600 a month rent, the mortgage is $2,850, and that's including taxes and insurance, I assume.
Correct. That would be principal, interest, tax, and insurance.
So you divide that, and that's and we're just going to example of how you come up with the debt service ratio. Now, what if it was $2,800 a month for rent and $3,600 for a mortgage, and the ratio was complete opposite?
Right. That's a great question. So similar to the hard money loans, debt service coverage loans offer rates and terms associated with a debt service, which is 1 or greater, meaning neutral or positive cash flow, or they have programs where it's negative or 0 cash flow. And that is where the rent is less than the mortgage payment. And therefore you have a negative amount. That would be considered negative cash flow. And they have programs for that as well.
I assume that's a higher rate because it's a higher risk.
Yes, well said. Yes, sir.
Because that's rates most people don't realize, but interest rates are based off of risk. The higher your risk, the higher your interest rate is. All right. So with this program we were just talking about, John was able, this is John buying this using the debt service program. He didn't have to show pay stubs, tax returns, W-2, 1099s, anything at all. He does have a 700 FICO score, but you don't have to have a 700. It's just, again, the higher your FICO score is, the better your rate's going to be because of risk.
Correct.
Right. And so and a lot of people think, well, don't you have to put 30% down or 40% down or 50% down? This is a 20% down purchase. He has to document that he has reserves, basically three mortgage payments. Now, my question to you is, this is just on this property. A lot of conventional programs, when we're buying property as investment, you have to do 3 months on every property you own, right?
Yeah. For this program here, we're just going to look at the reserves for the property in question, the subject property. Right. Reserves outside of that aren't considered.
Okay. Now, so basically what we're saying is, so what we went through, the scenario we went through, he can rent the place for $3,600, his mortgage payment's this, and that's his debt service ratio. And that's pretty close to what that interest rate is. And a lot of people will say, in this market, interest rates are 3% or less. This is crazy to buy this at 5%. But what a lot of people don't understand is, I'm using this for investors who own property already. They flipped it. They used hard money loans, which are 10 to 12%. And a lot of people don't realize that's how a lot of the flippers were using that money, because it was easy access, get the money, get the stuff done, boom, sell it, and they make their money back. It sounds like a lot, but over time, it's not. It's just short-term money is the most expensive money.
Correct. Yeah, exactly. Right. And this provides an opportunity for anybody who has that hard money loan to come in and get a lower rate, whether their current loan is at 9 or 10 or 11%, something in the 5s or 6s is going to be a dramatic change. Plus, they can, if they have equity in the property, they can use the loan for cash out purposes as well.
Well, speaking of that,
they can do some fixing up of the properties.
All right, so we have one more scenario we're going to do, which is a refinance scenario, which is kind of what I was talking about. A lot of people are using this to refinance their portfolio of hard money loans to get out of that. Because if you go from a 10% to even a 6%, you're going to save possibly a few $100s a month. So that means more money is going in your pocket, not the other person. Right. All right. So so you want to talk about this? This is your scenario.
Yeah, in this case, this is a very traditional. We see this quite often where you've got a borrower, in this case, Mary, who's looking to refinance an existing loan, which is a hard money loan, and she wants to get a lower rate. Plus, she wants to use some of the equity that has built up in the property so that she can affect some property repairs. And so, in this case, she was able to pull out $50,000 and get a lower rate. And all we did was use, once again, the amount that she collects per month divided by the principal, interest, tax, and insurance payment. In this case, her what she earns per month in rent is actually slightly less than what her mortgage payment will be, but these loans work just the same for that product or for that person as well.
And how much, I mean, what is the max negative? There's got to be a max negative, right, that you can do.
We consider anything under 75% as zero income, and we can use that.
Oh, really? It just basically, all right. So if I had, just as an example, if I had a 5% interest rate on the other way, are we talking like 7%? What are we talking? Do you know?
It could be as high. I've seen them as high as 8.5.
Okay, still better than
it definitely goes up into that those higher rate terms. But again, that borrower, typically that seasoned investor, understands the nature of this loan. And therefore, when they compare it to what they currently have, which would be a reason to do it, they can see the benefit in using it.
Right, because it lowers their, I mean, this is basically somebody has a high interest rate because it's a hard money loan and they're trying to do this. Or it could be somebody who, like you said here, Mary isn't really working. She's been helping other people, her parents, and she hasn't showed income, and she's able to take some money out of this property to fix it up and also take some money out. Because one of the things people don't realize is in the conforming world, basically there was a new thing put into place, which is called or I should say the QM world, the ability to pay rule, right? When it comes to a primary residence. And you run into where you try to take money out of that and you can't, because you can't show your income. Where if you have a investment property or you can take the money out of it without showing it because it doesn't come into play on that rule, correct?
Correct, because it's business purpose. It's the expectation is that you're working business to business as opposed to business to consumer. And so therefore the gloves are off, so to speak, when it comes to the person being able to come back saying, you sold me something that I couldn't afford to have.
Right. And this is basically the business. When we're talking business to business, it's basically they're an investor. That's the business we're talking about. Right? That
is correct. This program is ideal for what we call the seasoned investor. So there are some guidelines for first-time investors. And they have slightly higher and slightly stricter loan to values and debt to incomes. But when it comes to the seasoned investor, this is a great product for them to roll their current loans into and also extend the term of the loan. A lot of your hard money loans are going to be shorter 2, 3, 4-year terms, where this can extend that out to 30-year fixes.
Right. A lot of them actually are only like 5 years. Right.
Right.
So, and I'm not trying to tell you don't know what you're talking. I'm just saying
no.
They're
exactly.
even shorter. Some of them are 5 years, and that's all you have. That's max. We want to be paid off. We want to be paid off within 5 years or sooner. And this could, not that this loan will work for property, but we bought property, and that was we have a 5-year. It's amortized for 20, but we still have a 5-year balloon. We have to pay it off within 5 years. So
right. These loans also come as interest only as well. So if somebody's having a hard time qualifying for the debt service coverage based on a fully amortized principal and interest payment, we can look at just the interest only aspect, which would remove the principal portion and go ahead and then determine if there's a positive or neutral cash flow based on that number as well.
And for most people, it depends on the program, but principal could, the interest only portion of a loan can make a huge difference than principal and interest. It could be a few, $500. It depends on how much the loan is. I don't have my software running right now, so I can show that to you because we're on the Zoom or on this thing. So, but basically I just want to make sure people understood. And basically what I'm going to start doing is Wednesday is going to be new loan programs where I'm going to go over through Real Estate Jerky live new programs. And today was about debt service, how to use a loan to purchase a investment property and not actually have to show the income that you have, because a lot of people can't show enough income. Now, I do have a question, because I've seen in the past pre-pandemic People bought primary residence with this type of program. This is not made for a primary residence. This is made for a investment property, correct?
Correct. That is correct. This is for investors only.
And how do people get around that? Now, I'm not saying that we want to do that. I'm just saying because I know somebody who did that. What happens if they get, what's the ramification if someone does that?
Well, I mean, I can tell you, so some of the sure tell signs are if, for instance, the seasoned investor does not have their own owner occupancy, but that they're renting a place and then they're buying this, that's going to be a bit of a red flag for us, just that it's plausible that they could be buying this with the intent, let's say it's a duplex, that they're going to live in site A and rent out site B, which isn't entirely wrong. It's still an investment property for them, but it becomes owner occupancy. And this is for investment only. And the keys there are, because it's a business purpose loan, I don't know the end results, except I believe the loan could be called due if it was proven that there was malice going into it. It's just best to make sure that it's for the right investor. Again, seasoned investors look at this and they have a better understanding of it than maybe that first time investor.
Right. I just want to let other people know that there's programs out there to help you increase your portfolio for real estate, help you, do a bank statement loan to purchase a home. There's a lot of other programs you can do instead of just the traditional Fannie, Freddie, VA, FHA, and, that kind of stuff, and jumbo.
For sure. And this is just one more extension of that. It's a great product. It's a great tool for somebody who's in our industry. It's a great tool for them to have in their bag that they can use as needed.
Yeah, because with the changes that we went through from, the not pandemic, but from the Great Recession, where they changed a lot of the stuff we were able to do prior to that, it's just nice to have some of these programs come back that we can do this. Because one of the biggest things I hated after that was, you probably remember, were you around when World Savings was around?
Yeah, World Savings Bank.
Yeah.
I had a calculator of theirs.
Anyway, they had a pick-a-pay program. They had the original program that was great and it was only for business owners, right? And it was a great program to where you can choose your payment each month depending on how much your income came in that month, right?
Sure.
And so that program was amazing because it worked for business owners. The problem was when we went through 2005, 6, a lot of the banks grabbed it and started giving it to wage earners and saying, okay, well, you can pick your program each month. They're buying $700,000 houses and their payments only $2,000 or whatever. And that came back to bite a lot of people. And then we lost that program. So these are made for what they're made for, which is to help you buy an investment properties. Yes, the rate's a little bit higher than the standard rate, but that's based off of risk. And then you have to run the numbers and make sure it works. Because if your income from the property allows you to service this debt, then there's no issue. Because over time, the property is going to appreciate, your rents are going to go up, your mortgage payment is going to go down, you're going to do other things. So over time, it's going to have an opposite result, and it's going to help you going forward. So these are a good program to utilize if you have that need. I have a gentleman, we're going to be doing about 5 of these for him because he's got 5 properties that he wants to get out of hard money loans. So
that's fantastic. And it's perfect for that environment. And again, for somebody who's just looking to come in new, who doesn't have the income to qualify for whatever reason, maybe because of COVID or for a million other reasons, they can't prove their income. As long as they can document the existing or future rents, they can use that to offset the mortgage.
And they're documenting that through a lease agreement. How do they document that? So if it's a new purchase, is that through the appraisal? Or
it's going to be an appraisal survey, correct? We'll use an appraisal survey to determine the value of that property.
And that's whether it's a purchase or a refinance?
No, if it's a refinance, they'll use, if it's a refinance.
Sam, tell them hello for us.
Yeah, sorry about that. If it's a refinance, we'll use either the existing lease or the 1007, which would be the appraisal rental survey.
Right.
We'll use the lower of the two, but lean heavily on the existing lease.
Right, because just because I know a lot in certain counties, the rents are ridiculously high. Even though if you do a rental survey, the actual appraiser doesn't always know what everybody's getting for rent. They call around, they check a few places, but they don't really know. If you have a lease and you have proof of that you've been receiving those payments, you will take the lease over what the appraiser says, correct?
Exactly. They're going to want to see evidence 3 months, 6 months. They're going to want to see evidence that those leases have been paid consistently.
Right. Not just all of a sudden new ones.
Right.
Yeah.
Right.
Yeah. That happens all the time, right? Nobody wants to lie. These are programs where you don't need to do anything wrong because these are great programs. They're there for a reason. Utilize them to help grow your personal wealth through home ownership.
Yeah.
And that's why we bring the show each week to help you understand what you can and can't do in buying property. So, Brad, I appreciate you coming on and talking a little bit about it. And we'll find some other programs to talk about over the next few weeks. But again,
we've got actually we have some new programs coming out. So I'll keep you advised. We've got a new construction to permanent construction loan coming out. So I'll keep you advised.
When's that coming out?
If they're rolling it out, it's not 100% certain. It's just talk in the wind right now, but it's forthcoming. So
yeah, because I mean, one of the issues we're running into is there's limited people doing construction loans. They're there, right? But it's a lot harder. So when that comes out, I'd like to talk to you about that because I might need it. You never know. Yeah.
Well, there's a whole demographic out there that wants to build their own home. There's this whole demographic of people in certain age brackets that are enthralled with the idea of being able to buy their own property and build their own home, as opposed to the alternative, which would be a developer's tract of sorts. So
yeah, and the problem you run into is because the properties are so. I mean, it still was cheaper up until this point to go buy the property, right, than build it yourself. Once the prices of wood and everything else comes down, then it would be more. It makes more sense to build your own home, and that's why we bought 32 acres up in Twain Harte to build our forever home on. Got it cleared, ready to go. Pandemic hit. Everything was put on a wait. All our plans are in. Everything is approved. Now we decided to split the property, which takes another 8 months, right? And then we're going to start going, which is okay because the price of the wood went up so high and everything else.
Give you a breather on that.
Yeah. So again, Brad, I appreciate you coming on today talking about this program. And if anybody has any questions regarding this program, reach out through me, direct message me through Facebook or through YouTube, and we'll get that information for you. Brad is a wholesaler. They don't actually do retail, correct?
That's correct. We just work with you, Ed.
Right. Well, not only me, but other people like me. So you don't reach out to Brad unless you're a broker or somebody else who needs this program. Reach out to Brad at Fund Loans. All right. Thank you, Brad. Stay right there.
Thank you, sir.
And everybody else, thanks for showing up today. If you're watching this afterwards, just let us know. We appreciate it. And have a great day.
Thank you.